Welcome to the Deep Dive. It's October 9th, 2025, and today we're jumping straight into a fast-paced look at sources covering, well, a whole spectrum: global markets, policy shifts, tech disruption. Yeah, our goal here is to really connect the dots. How does something like, say, U.S. tax law changes link up with the fight over minerals globally, or the rise of luxury spending, or even the new regulatory battles over AI?
Exactly, because the main theme we're seeing today, I think, is this major shift in global control. Whether it's tax rules, corporate strategy, or, geopolitical leverage. Power's moving. We're mapping the pressure points.
Okay, let's map it out then, starting right here in the U.S. So the immediate thing is the federal government shutdown. Day 9 now. And look, our listeners get it. This isn't just about closed parks. It's systemic.
It really is. I mean, the headline numbers are stark, sure. The IRS has furloughed almost half its people.
Right.
And you've got the Delta CEO warning about air travel impacts if this drags on another 10 days because of air traffic controller shortages getting worse. We're already seeing, 13,000 flight delays this week linked to that?
Oof.
But the deeper thing, the bit we often miss when we just focus on flight delays, it's the regulatory freeze, the economic gears just grinding down.
How so? What are those gears?
Well, think about it. Stalled guidance for big financial players, delays getting new government contracts approved, halts on environmental energy project permits, uncertainty. That's the real market killer here.
And this gridlock generates a ton of it.
Precisely. And politically, the temperature's definitely rising. President Trump is threatening to use this shutdown specifically to try and permanently cut programs he calls very popular Democrat programs.
So it's shifting from just a budget fight to maybe a structural policy battle?
That seems to be the threat, yes. It raises the stakes significantly.
Okay, so the system's stalling out, but life and taxes, they keep rolling. The IRS, even with that skeleton crew, managed to push out the 2026 inflation adjustments, filed in 2027, of course.
Right, and this is where long-term planning really comes into focus for you listening.
So what's the key takeaway there?
Well, the standard deduction is up a bit, $16,100 for single filers, $32,200 for married filing jointly. That's, helpful.
Okay.
But the real nugget, I think, for wealth planning, it's the long-term capital gains, specifically the 0% bracket.
Ah, right. That's the sweet spot. Tell us about that expansion.
It's actually pretty substantial. The income level where you pay 0% on long-term gains, it's jumped quite a bit. Single filers can have up to $49,450 in taxable income and pay 0%.
$49,450. Okay.
And for married couples filing jointly, that threshold is now $98,900.
Wow, nearly $100,000. That's a huge planning opportunity if you're managing investments.
It really is. And remember, the key phrase is taxable income. That's your adjusted gross income after you take your standard or itemized deductions.
Right, so it's not just your raw income.
Exactly. So if you're thinking about, say, RF conversions or timing the sale of stocks you've held long-term, you can strategically manage deductions to try and keep that taxable income figure just under those limits. It saves potentially thousands in taxes.
Makes tax planning not just an end-of-year thing, but an integral part of your investment strategy all along.
Absolutely essential.
Okay, so we have this domestic chaos, maybe weakness, with the shutdown. And globally, that kind of weakness often gets exploited, right? New ways to exert control emerge.
That's a good way to put it.
Yeah.
Let's shift from U.S. gridlock to, global trade strategy. Specifically, China's latest move on rare earths.
Yeah, this feels like a big deal, especially coming just before that expected Trump-Xi meeting.
Oh, it's a calculated move, a sophisticated one. China's tightening the screws on rare earth exports. New rules just dropped.
What do they say?
Basically, you now need a license to export any product that has even 0.1% rare earths.
Okay, that's broad.
And here's the kicker. Or any product made using China's extraction or refining tech.
Wow. So they dominate the supply chain, and now they're saying, if you use our methods, even outside China, we control the export.
Pretty much. It's not just about the materials anymore. It's about controlling the know-how, the process globally. It's absolutely designed for negotiating leverage.
And how did the market react?
Instantly. U.S. rare earth miners, critical mineral stocks, they jumped. MP Materials was up, over 6%? Lithium America's up around 2%.
So you see that direct line. Geopolitical risk spikes, and money flows into trying to build domestic alternatives.
Exactly. And it's not just the market. The White House has skin in the game now, right? They've taken equity stakes in some of these companies, MP Materials, Lithium America's, Trilogy Metals, trying to fast-track a U.S. supply chain.
Because these aren't just commodities anymore, they're strategic assets.
That's the bottom line. But the strategy behind this latest China move, it's raising eyebrows. Analysts are calling it lawfare.
Lawfare. Okay, that sounds intense. Is it really warfare using laws? Or is this just, sharp-elbowed economic competition? I mean, the U.S. used things like the foreign direct product rule first, didn't it?
It did, and that's a fair point. But this feels like an escalation, maybe in scope and intent.
Right.
Lawfare, as it's being discussed here, is the deliberate use of legal systems and regulations as strategic weapons to achieve geopolitical goals.
So more than just tit-for-tat trade rules.
Possibly. China's built up a whole arsenal, reportedly over 20 statutes now. And this week, they expanded their unreliable entities list, the UEL, added 14 Western firms.
And the standout name on that list was Tech Insights, a semiconductor intelligence firm. Why them? Not a chip maker, but an analysis firm.
That's what's so revealing, I think. Tech Insights is basically the CSI of the chip world. They tear down new chips, figure out how they're made, who has the tech advantages, map supply chains.
Ah, okay. So they provide the intel.
Right. So targeting them isn't just about restricting physical goods. It's about attacking the West's ability to even understand what China is doing technologically, to do competitive intelligence, to figure out dependencies.
It's hitting the information infrastructure of the whole competition.
Precisely. And the signal's pretty clear. Just following U.S. law, like export controls, could now get you punished by Beijing under their laws. It's a whole new level of legal entanglement.
Okay, let's pivot now. From geopolitics and supply chains to the consumer. Because the data there shows this really stark divide, doesn't it? This K-shaped recovery seems, well, permanent.
It certainly looks that way. Delta's Q3 earnings are a perfect example. They beat expectations, right? But how they beat them is the story.
Driven by luxury.
Almost entirely. Look at this split. Premium travel revenue, think first class, business class. The roomier seat to jump 9%. Almost $5.8 billion.
9% up. Okay.
But main cabin revenue actually fell 4%, down to $6 billion.
Wow. So the front of the plane is booming, the back is shrinking.
And Delta's betting this isn't a blip. Their executives are projecting premium revenue will actually overtake main cabin revenue next year.
That's not just recovery. That's a fundamental shift in their business model, focusing squarely on the high-end traveler.
Exactly. And others are noticing? United's jumping in, launching new nonstop international flights. Not to major hubs, but to these exclusive smaller destinations. Think Bari in Italy, Split in Croatia, Santiago de Compostela in Spain, places appealing to travelers with cash to spend.
So macro worries, inflation. It just doesn't seem to be hitting that top tier's travel budget.
Apparently not. But it's not all smooth sailing in the luxury space. Look at cars, specifically the EV transition for luxury brands.
Right. Ferrari had a really rough day. Stock tumbled, 15%? Worst day since their IPO back in 2015.
Yeah, a big shock. And it was tied directly to them pulling back on their electric vehicle targets.
What did they change?
They significantly scaled back their 2030 goal for fully electric cars. It was 40%. Now it's down to just 20%.
Only 20% EV by 2030?
Yeah. The new target mix is 40% traditional internal combustion engines, 40% hybrid, and only 20% full EV. They cited a client-centric approach, basically saying their customers aren't demanding EVs as quickly as they thought.
So even for luxury buyers who can afford anything, the pure EV experience maybe isn't quite matching that traditional Ferrari feel yet.
That seems to be the signal they're sending. The tech pitch alone isn't enough, at least not yet, for that very specific, very high-end market. It's about the legacy, the sound, the whole visceral experience.
Interesting. So the physical luxury world, like Ferrari, is maybe pumping the brakes a bit on pure tech disruption. But the digital world, it feels like it's accelerating past every red light.
That's a good way to put it. Which brings us to AI. The speed of innovation is just staggering. And the risks are keeping pace.
We're hearing more warnings, even from industry insiders.
Yeah, former Google CEO Eric Schmidt had some pretty chilling comments. He warned that AI models can be hacked, their safety guardrails removed. He claimed, quote, they learn how to kill someone.
Yikes.
He called it a major non-proliferation challenge, like trying to control nuclear weapons tech, but maybe even harder because software spreads so easily.
But at the same time, didn't he also say AI is underhyped for its economic potential?
He did. And that's the tension, right? Immense potential, immense power. But maybe we can't actually control the risks adequately. We're deploying it faster than we understand it.
Running before we can walk, as they say.
And you see that tension playing out immediately with copyright. Look at OpenAI's new video app, Sora.
Right, the text-to-video generator. It's invite only, but it still hit 1 million downloads in under 5 days.
Incredible speed. And Hollywood's reaction. Fury,
They're not seeing innovation, they're seeing theft.
pretty much.
Yeah.
Major talent agencies, the MPA, they slammed it as exploitation,
Hmm.
pointing to examples where it's generating clearly copyrighted characters like SpongeBob without permission.
So the tech is moving way faster than the legal frameworks needed to handle things like IP rights.
Way faster. And it's not just generative AI where risk containment is an issue. Look at the vehicle market again. Tesla's facing another federal probe.
This one's about FSD, full self-driving.
Yes. NHTSA, the safety agency, opened a new investigation. It covers almost 3 million Teslas.
3 million. What triggered it?
They cited 44 reported incidents, cases where the FSD system allegedly did things like run red lights, steer into oncoming traffic, or commit other violations that led to crashes.
So not just minor glitches.
No, potentially very dangerous failures. The core question seems to be whether drivers really have enough time to react safely when the system suddenly does something unexpected and wrong. It puts the focus back squarely on the reliability and safety validation of these advanced autonomous systems. #@out.
Okay, let's try and pull these threads together. We've got domestic policy chaos, global trade turning into lawfare, consumer splits, and runaway tech risks. Is there a central theme connecting these on, say, Wall Street?
There is. There's a lot of talk about something called the debasement trade.
The debasement trade. Explain that.
It's essentially a bet that all these factors we've discussed, the U.S. political gridlock shown by the shutdown, the rising geopolitical tensions, the weaponizing of trade laws, plus expectations the Fed might have to cut rates eventually, that all this will combine to erode the value of the U.S. dollar over time.
So a loss of faith in the stability of the dollar and maybe the U.S. system itself?
That's the core idea. Instability breeds a flight from traditional fiat currency, and people are looking for alternatives.
And we're seeing proof of that flight in asset prices.
The numbers are, frankly, pretty astounding. Gold is up over 50% this year. It's trading above $4,000 an ounce.
4,000. Wow.
And Bitcoin, it's blown past the $120,000 mark. You just can't dismiss that level of movement as pure speculation anymore.
It feels more structural.
Exactly. It looks like a structural hedge. You're hearing experts now openly advise putting a significant chunk of portfolios, maybe around 20%, into alternatives like precious metals, crypto, basically assets outside the traditional system to hedge against this perceived debasement risk.
Now, amid all this volatility, we should mention there are efforts to stabilize things, right?
Absolutely. We did see a major diplomatic breakthrough with the Israel-Hamas ceasefire agreement. That's huge for regional stability.
And economically?
On the economic front, the U.S. Treasury actually stepped in to support Argentina, buying pesos and finalizing a big $20 billion currency swap line to try and stabilize their markets. So yes, there are definitely counter efforts to manage the volatility.
Okay, so we've gone from your personal tax planning for 2026 all the way to global trade wars fought with laws and the untamed frontier of AI risk. Quite the journey today.
It covers a lot of ground, but it's all interconnected.
So let's leave our listeners with this final thought to chew on. If this idea of lawfare is real, if the main way nations and big companies compete is shifting away from just military power or sheer size towards strategically using laws, regulations, IP rights as weapons, how do businesses need to change? How should a global company restructure its operations, its legal strategy, its compliance, just to survive in this new kind of economic battlefield over the next decade? Something to think about.